A disastrous day for Hong Kong today, the main stock index taking its worst plunge since the worldwide markets crash a decade ago. Tonight, analysts said Hong Kong's fight to hold its currency peg against the American dollar had only just started, and that the stock market was expected to plunge even further as Japanese investors pulled out. But Hong Kong executive Tung Chee-hwa said his government was determined to maintain the peg.
To do this, we have signaled to the market our determination. The interest rate has gone up, and as a result of that, there is a short-term repercussion on the stock market, and this is to be expected. But on the stock market side, all our major companies have very good performance. Their growth in profit is all double-digit, and the fundamentals, again, very good, basically because the Hong Kong economy is good.
Tung's confidence has not helped quell anxiety over the territory's predicament. On a day when foreign funds fled Hong Kong, panic was triggered in smaller markets across the region.
Investors could only watch as panic sent stock prices tumbling. Analysts had assumed Hong Kong could withstand the region's currency crisis. Within moments of the stock exchange opening, they were proved wrong. The Hang Seng plummeted as much as 15%, hitting a record low. It finished the day 1,245 points down. Hong Kong stocks have now lost 25% of their value in a week.
It's really panic. Everybody just dumped their shares to get cash on hand.
The sell-off began as speculators stepped up their attack on the Hong Kong dollar, the last major Asian currency pegged to the greenback. The territory's central bank was forced to defend the currency, sending local interest rates soaring.
The rates normally around 6% and today are hovering around 150% for an overnight loan.
The crash sent shockwaves around the region. The Japanese stock market fell more than 3%, Singapore down 5%, Malaysia down 4%, the Philippines down 5%. Australian stocks also suffered, the All Ordinaries plunging 68 points or 2.5%.
What it means for the region, for Australia, is that we're going to see a period of substantially slower growth over the next year or so, and it could extend much further than that. It may extend for 2 or 3 years.
It raises issues, obviously, about the viability of the whole region when we see these continued ructions.
Because of that, analysts warn the crash could put further downward pressure on the Australian dollar. International investors have been selling the currency as they become increasingly nervous about the impact the crisis will have on the Australian economy. During the last week, the dollar has lost more than 3% of its value. Overnight, it hit a 3.5-year low against the greenback before recovering.